Recording stopped.
Hi, good afternoon, everyone. I think we will just wait a few more moments for any other attendees to join us first before we begin the webinar. In the meantime, can you all hear me? If you all can hear me, can just put a thumbs up or some comments lah, so I can know everything's in order. Yeah, thanks. Okay, Ken. I think we'll begin the webinar first. So I assume all of you can actually hear me quite clearly. Yeah, so I'll begin. So good afternoon, everyone. Thanks for joining this webinar today. My name is Brian. Okay, I'm actually standing in for my colleague, Christine, who's on urgent leave today. Yeah, so I'll be handling this webinar on her behalf. Yeah. So before we actually carry on with the webinar, right, these are just some disclaimer uh about the slide or the webinars lah. I mean, anything that you see on the webinar today is meant for sharing purposes, and it's not a recommendation for any buy or sell calls for your personal investment. All right. Of course, along the way as well, if you do have any questions, you can leave it in the chat, and I will actually get back to you during the Q&A session. Okay, so before we begin, I'll share a bit of our corporate profile. So for Phillip Capital, we actually established in Singapore since 1975. We actually started off as a stockbroker, but over the years, Phillip Capital has grown into integrated financial house with global presence. Okay. So I mean, we cater to our retail investors, high net worth individuals, family office, as well as corporate institutional customers. So corporate profile wise, we have currently over 50 billion USD under asset management. Okay. Shareholders funds of more than 2.5 billion USD, over 1.5 million clients worldwide, and over 5,000 employees as well. Okay, a bit of our profile of our founder. So our chairman, Mr. Im, is the founder and chairman of Phillip Capital and its subsidiaries, as well as chairman of IFS Capital, which is a listed company in Singapore. Okay, he's also previously a board member with IRAS, and also a number of committees and subcommittees on the SGX. Right. This is just some global presence that we are currently in 15 countries. Of course, our headquarters will be in Singapore. Yeah. So just on the Singapore side of the business or the company profile, we're actually the largest market share for retail investors. We're also the largest CFD provider in Singapore, and we have the largest number of investor centers around the island. So just some key information of our group. We are actually the first to introduce online trading in Singapore. Also the first to launch regular saving plans for shares, as well as first to bring CFD to Singapore as well. Like I mentioned, we started off as a stockbroking firm. However, over the years, we have actually diversified and expand our range of financial products to bonds, forex, unit trusts, fund management, sorry, as well as other products. Yeah. So this is just a snapshot of our worldwide affiliated offices. So as you can see earlier, we have a global presence in more than 15 offices, and each country, these are the various companies or our subsidiaries. Okay, Ken. So now we will begin more on the webinar today, right? So I mean the main purpose of you joining us today would be to understand more about bonds and also understand what is a bond, actually how can you invest in the bonds, right? So just put it simply, what is a bond? It's actually a loan taken by a company. So usually for businesses, they can actually take a loan from a bank. However, sometimes they may choose to take a loan from investors by issuing bonds, right? So how a bond work is the company will actually create the bond, which is bond origination, and then they'll market the bond and sell the bond to potential investors who believe in their company. Okay, so in return, they will actually give a coupon payment to the investors. And of course, at maturity, they'll return the capital to the investor. All right, so in exchange of capital, the company pays interest in the form of coupon payments, usually but annually or biannually, and will repay the principal on the maturity date, ending the loan. Okay, so there's actually many features of a bond. I'll just go through you the 6 main features of a bond. First will be the maturity. So maturity is the date when the principal amount is paid to the investors and the loan ends at maturity. Right, so every bond that is issued, there will be a fixed date that the bond will mature, unless it's a perpetual bond. Okay, so different types of loan tenure, right, will be short term, medium term, and long term. So short term usually matures in 1 to 3 years, medium term about 5 to 10, and long term will be more than 10. For bonds, right, there's also a secured and unsecured bonds. So secured will actually refer to collaterals being pledged to the bondholders. So what this means is, in the event that if a company defaults on the payment or the capital of the bond, the bondholders will have a right to claim some of the assets, all right, that is being used to secure against the bond. So relatively saying secured bonds are quite safe in a sense because it's backed by some kind of assets. All right. Unsecured bonds are not backed by any collateral, so it's actually riskier as these bonds return a small amount of your investment should the company fail. Okay. Liquidation. So liquidation happens usually when the company is unable to pay its coupon or its capital back to the bondholders, that is when there's liquidation come into play. Usually when a company is facing bankruptcy or liquidity issue. Okay. So how does the liquidation process work? Usually the firms will actually sell off its assets, pay the senior debt holders first, followed by junior debt holders as well, and then followed by the stockholders, means the shareholders. So coupon is actually the interest paid to the bondholders. So coupon rate is actually calculated based on the annual coupon payment divided by the face value of the bond. Usually the coupon rate will be fixed at a point of issuance of the bond. Okay, so for tax status, some government bonds are actually tax exempt, and then these bonds usually have low interest compared to the ones that are taxable. Next, last one would be the callability. So if a bond has a call provision, the company has the option to pay off earlier than maturity, usually at a slight premium to par. All right. So what this means is, the bond may issue a 10-year bond. However, they put a call option that says they have the right to call back every 5 years. They have a decision to make. So they can issue a bond that is 10 years, and then after the 5th year, if they choose to call back, they have the right to call back and pay back the principal to the bondholders, and thus ending the loan tenure. Okay, so some basic pros and cons of a bond. So the advantages is, for a bond, you receive income through coupon payments. You hold a bond to maturity and receive back your principal sum. You can profit if you resell the bond at a higher price. Predictability, you are informed on how much interest you will receive and how often, compared to stocks, whereby dividends is based on the profitability as well as the dividends declared by the management. Attractive interest rates paid usually exceeds that of the bank. All right. So disadvantages of bonds pay out lower returns than stocks. Companies can default on your bond, and bond yields can fall depending on the interest rate environment. Okay, so risks associated with bonds. So the first one, and it's actually the most important thing related to bonds, would be the interest rate. So interest rate risk, right, happens because interest rates and bonds have an inverse relationship. So what this means is, usually when the interest rate environment is on a uptrend, which is what we are actually facing now in the current market condition, bond prices will tend to react inversely. Of course, what you can say is, once interest rates start to cut, you can expect your bond prices to also rise. Okay. So interest rate risk comes when rates change significantly from what the investors expected. Yeah. So if an interest rate rise, the investor will be stuck with an instrument yielding below market rate. So what this means in simple terms would be, if you actually bought a bond maybe 1 year ago, that you bought 4%, and then throughout that 1 year, the interest rate environment has been increasing, the same bond or a same bond issued by a company 1 year later will most likely issue the bond at a higher coupon rate compared to the bond you buy 1 year ago. And due to that simple fact that the interest is paid, the coupon is higher than the bond that you buy, your bond price will tend to be negative. Yeah. So if interest rate falls, the investor face a possibility of prepayment. So I'll touch that on prepayment on the next slide. Okay, the greater the time taken for maturity, the greater the interest rate risk. So what this means is, the longer the tenure of the bond, right, any slight change in your interest rate environment will actually affect the longer tenure bonds more compared to a shorter tenure bond. Okay, the next risk will actually be credit risk or default risk. So this is also the second most important risk, because as a bondholder or a bond investor, you will not want this to happen to your bond. Okay, so credit or default risk is actually the risk that the interest or the coupon or your principal payment will not be made by the company. Okay, so when you actually choose to invest in a bond, as investors, you should actually look at some criteria or some figures before you actually choose to invest in bond. So some of these financials are actually the operating income, the cash flow, as well as the debt of the company. Okay. So prepayment risk. So like I mentioned earlier, prepayment risk is the risk that that a given bond issue will be paid off before maturity. So like I mentioned on the previous slide, this will be linked to the callable option. So for a bond that maybe for example give 10 years maturity, and they have a call option on the 5th year to redeem. So what happens is if the interest rate environment starts to decrease, then the company may choose to call back your bond earlier if the coupon that they are paying you is higher than the current interest rate environment. So what this is a common process would be the company will call back the bond and they will issue a new bond at a lower interest rate. Right. So this is the prepayment risk, which you do not have any control on. Usually it's the company has the right to call back. Okay, so for bonds versus stocks, so what are some of the main differences? So bonds is actually a debt that the company issue. Okay, this debt actually make uh this debt is actually made with an investor for cash in exchange for payout interest. So typically traded over the counter. So what it means over the counter is unlike stocks whereby you can actually track the pricing, live pricing on any exchange, right? Over the counter means usually you have to go through your broker, your relationship manager to check for you uh the counterparty if there's any potential buyer or seller of that bond that you currently have. Okay. For bonds also is generally lower risk, lower rewards. So this is just some figures that we took from 1929. If you're invested into a bond, average you have earned about 6% each year. Okay, bonds can also be made as corporate, municipal or treasury bonds, besides just the normal corporate line. So for stocks, stocks actually give you the ownership or stake in the company. Unlike bonds, which is a debt, stocks actually give you the ownership of the company. So as you also have a claim to a company's asset and earnings that often give the investors voting rights and pay dividends. So when you actually invest in bonds, you are owner of a company. Of course, you will get back dividends if the company perform well. Typically, stocks will be traded through one of the central exchanges. In this is example is a New York Stock Exchange, but of course in Singapore will be our Singapore Exchange. Generally, for investment into stocks, it's a higher risk compared to bonds. Of course, with higher risk, there's also higher potential returns. Since 1929, you will earn about roughly 10% each year. Stocks are usually issued by companies during an IPO, or of course, you can also buy it through the secondary market on the stock exchange. Okay, so I'll move on to the 5 main types of bonds. So the first one is angel bonds. Angel bonds are referring to investment grade bonds with credit rating ranging from BBB to AAA and usually offer a lower interest rate. So if the bond issuer's ability to pay the bond principal is reduced, the credit rating may fall below investment grade minimums and become a fallen angel. So what this means is a company may issue a bond at their peak of their earnings. Maybe they're earning great profits, right? And the company assets are very stable. They could give you maybe AAA rating. However, over the years, maybe due to poor management, company earnings has dropped. They are in more debts. They are facing difficulties paying off their interest or even their capital. So this may result in a re-rating of their bonds from AAA to a lower grade or even to a junk bond status, which is BB and below. Okay. So next will be callable bonds. So like I mentioned earlier, bonds that can be redeemed by the issuer prior to the maturity date. Of course, it won't anyhow, the issuer won't anyhow go and redeem a bond whenever they feel like it. For callable bonds, usually there will be a date stated into your bond. They say only on this date do they have the right to call back the bond. Right? corporate bonds, like I mentioned, short term, medium term, long term. High yield bonds, also known as junk bonds. So for these high yield bonds or junk bonds, they are usually credit rating double B and lower due to their high default risk. However, because of their high default risk, they will actually have to offer a higher interest rate to attract investors to invest into their bonds. Right? I mean, you can compare, for example, company A, which is a grade A, triple A rating bond, compared to company B, which is a double B rating bond. If both bonds give the same coupon rate, logically you will choose the company A, which is the triple A rating. Because for the same amount of interest rate or coupon that you're going to receive, you're actually buying a lower risk company. Okay, so for perpetual are bonds that have no maturity date, meaning it lasts forever. As long as the company is still operational, the company still exists, this bond will last forever. But for most of these perpetual bonds, they do set a callable date or callable options in the bond. Usually it's every 5 years. So for example, company A give a perpetual bonds, usually they'll put a callable option for the 5th year. So means on the 5th year, they have the right to choose to call back or leave it there. So after 5 years, if the company choose to remain, do not want to call back the bond, it will run for another 5 years before they make another decision if they want to call back the bond. So when you link it back to the prepayment risk, this usually only happens if the interest rate environment is low. So during an interest rate environment that is low, if the company can actually issue a new bond at a lower coupon rate, that is when they will call back this perpetual bond instead. Right? Okay, next will be the trading strategies with bonds. So for bonds, right, there's actually a few ways as an investor you can actually get exposure to bonds. So through Singapore context, one of the safest way for investor to get into bonds will be through investing with MAS or government bonds. What we call the are the SGS bonds or T-bills. You can also refer to the Singapore saving bonds if you want. So those are all government related bond issuance that you can actually consider, and recently through the past 1 to 2 years is a very popular product among the local investors who wish to actually enter the bond market due to the higher coupon that they are giving because of the higher rate interest rate environment currently. Okay, so you can actually buy Singapore government securities or T-bills using cash, SRS, and CPF investment funds. Most of these bonds are issued minimum investment of 1,000. And of course, there'll be multiples of 1,000 as well. For application methods, cash, you can apply to one of the 3 local banks, through the ATM or the bank portal. For SRS, you will do it through the same 3 local banks, as well as a CPF. Okay. Next will be actually investing in corporate bonds. So for corporate bonds, unlike government bonds, they tend to have higher risk associated with them because you have to rely on the performance of the company that issue the bonds. So these are just some examples of the corporate bonds that we do have currently on the market. Like I mentioned earlier, disclaimer, this is not a buy or sell call. Okay, this is just for a sharing purpose for this seminar. Okay. So just for this one, it'll be like the maturity 2024 to 2026, shorter term tenure. Then we have a mid-term tenure about 2027 to 2029. Okay. And the longer tenure. So one thing about corporate bonds would be, for most corporate bonds, the minimum amount that you actually invest in is actually usual 250,000 SGD. And to actually buy a corporate bond, you will have to be a accredited investor who have a criteria of at least 2 million in assets or 1 million in financial assets. Alternatively, you can also have an annual income of 300K. Okay. But if for normal retail investors, I mean, who are accredited investors in a sense, sometimes putting 250K into just one single company or one single bond could be highly leveraged to you for your portfolio. So at Phillip Capital, we do have something called the Bonds 50. So Bonds 50 is technically the same bond as a normal bond. However, we are willing to split it into five, so that it provides more affordability for you to buy, just starting with 50K rather than 250,000. Okay, of course, for bond 50, it's not applicable to every single bond. So if you're actually interested in some of the bond 50, you can actually contact us, or you can log in. If you have an account holder of ours, you can actually log into your system and then search bond 50. They will actually show you which bonds are applicable for this bond 50. It's traded exactly the same as any other bonds. It's just that denomination wise it's in 50,000 instead of 250,000. The next bond instrument that you can consider if you are not a accredited investor or you do not have 250,000 to invest in would be unit trust. So you can actually invest in unit trust. That main objective is to invest into bonds. And then actually for unit trust, it gives you a lot of different kind of exposure. For example, you can invest into China market, India market, US market, depending on the bonds. So if you are more interested into invest in the US fixed income market, you can actually find unit trust and invest in that. For some, you may find maybe China or a country specific bonds may be too high a risk for you. You can actually invest into a unit trust, for example, the example on the screen here, BlackRock Asian High Yield Bond. So what this means is the BlackRock will actually take your funds and invest into various bonds, not just China, but maybe a basket of countries, right? So it helps you to diversify into different country allocation, different sectors or different company. For the same amount of funds that you put in, you get diversification as well. So investing in a bonds unit trust, some of the perks our company currently have would be, if you actually can buy online yourself, there's 0% platform fee, 0% sales charge, as well as 0% switching fees. So if you're new to investing in the unit trust or new to finding bonds unit trust, you can actually go to our unit trust website. There's a QR code on the screen. You can actually scan it. It should lead you to our Poems Fund Finder website, whereby you can actually search the various fund manager if you have a fund manager in mind, or the fixed income. And then you can also search the currency of the funds, and then they'll actually filter for you to the appropriate funds houses, right? So this is just a snapshot of what a bond fund fact sheet is. So from here you can see, like I mentioned, this is not a recommendation for you to buy. It's just purely for sharing purposes. So for example, you can see that for these bonds, the fund manager is actually BlackRock, the largest fund manager in the world. So the main purpose of this fund is to invest into Asian high yield bonds. All right. You can actually see the fund size of this portfolio, which is about 1.5 billion US dollar. And they will show you the top 10 holdings. So I mean, depending on which fund house, they will actually disclose more or less information to you based on their fact sheet. Okay. Okay, so for bonds wise, the normal corporate bonds, you can actually trade it through Poems. There's no commission, no processing fee, no platform fee. There's also a competitive spread, and we have actually access to more than 70 counterparties and 9 different currencies. So what's good about having 70 counterparties, right? Is put it simply, because like I mentioned earlier, for corporate bonds, it's not traded like a stock on a stock exchange. So you personally as an investor cannot see the live price. So what this means is, if for example you are a bond holder today and you wish to actually sell your bond, we will actually contact our counterparties for them to find a buyer for you. If they have the buyer in mind, then the transaction can be done, right? It's a willing buyer, willing seller kind of transaction for bonds. So of course, with our large counterparties, it's going to be easier for you to actually liquidate your bonds if you actually need to. Next good thing will be we actually participate a lot in both the primary and secondary bond markets globally. So this means every time there's a new issue, Phillip Capital will most likely have also some of the bonds to offer to our clients as well. Last will be Phillip Capital network office is in 15 different countries and region. So we actually can give you a better understanding of the various bond markets, companies as well. We do have our own Phillip research team that actually give you research report, analyst report on certain companies. So like I mentioned earlier, one of the criteria for bondholders to invest is you must actually do your research on the underlying company's financials, such as net profit, cash flow, as well as the debt, before you jump in. Most investors will make the mistake of investing just because a higher coupon attracts you and you choose to invest. So over the years, there are very high profile cases whereby good quality companies actually defaulted on their bonds, whether it's just a coupon or for the principal amount. All right. So this is something you would have to take note of if you choose to invest into bonds. Okay. So I mean, like I mentioned earlier, I'm just coming from my colleague, Christine. Okay. So besides bonds, we do have other products, stocks, ETF, managed account, insurance as well. All right. So if you are actually interested or you're actually new to investment with Phillip Capital, do reach out to us. We do can actually give a call or email in to my colleague here, or you can just call in looking for me, and then we can actually help you discuss about your current portfolio as well as any advice you need. Okay. Before I actually move on to the Q&A, the last slide here would be do join our socials, whether is it through Facebook, Instagram, Telegram. Do join our socials to keep yourself updated on some of the market news, company promotions that we currently have. Yeah. So I'll just leave this screen here for a while first. So if you want, you can just join any of our socials, and then keep yourself updated lah, the financial news. Okay, can. So I'll leave the screen here, but I'll move on to the Q&A first, because I see there's quite a number of questions being asked, right? So for anybody who are interested or you have any questions, just leave your comments in the Q&A and I'll try my best to get back to you. All right. Okay, so I have a first question here, which is it not better to buy a bond ETF instead of individual bonds? Okay, this is a very good question. So there are such ETF that actually tracks a bond index or invest into bonds. Singapore, there's quite a few also. I think about around 10 different ETF that actually has bond exposure. So for this question, is it better to buy a bond ETF compared to an individual bond? There's no right or wrong. Okay. Buying a bond ETF give you diversification into various bonds. Compared to if you buy an individual bonds, right, you're just buying to just one company. So if anything happens to that company, whether is it cash flow or uh cash flow issue, net profit issue, or what, they can't pay, that's it. Your bond price will definitely be affected. Or worst case scenario, if the company go bankrupt, you'll lose almost all your capital in a sense if the company go bankrupt investing into an individual bond. However, if you actually buy your bond ETF, you can reduce your risk of such a default because usually it's a basket of bonds. So the risk will be, I'll say, lesser. It's better because bonds ETF are traded on a stock exchange, meaning you can actually track the prices daily, and then you can actually sell a portion of it if you want. So like I mentioned, a corporate bond is 250,000. In most scenario, if you want to sell that bond, you have to sell the whole 250,000. But imagine if you buy 250,000 into a bond ETF. If you just need 50,000, you can actually just sell 50,000 worth of the ETF rather than selling the whole portfolio. Good and bad is for bond ETF, usually because it's traded like a stocks, right? So there will be a exercise date or cut-off date, right, for the dividends. So you usually pay dividends for a bond ETF, but there will be a fixed date. Meaning if you actually sell before the XD, you will not be entitled for the dividend. But for buying an individual bond, you'll be paid the dividends because dividends for individual bonds are based on accrued interest. Meaning for every single day that you hold a bond, you'll be entitled to the interest, regardless when you sell the bond to the next buyer. The buyer will have to pay you for each day that you have hold the bond before the coupon payment date. All right. So I hope that answers your question between ETF and an individual bond. One more point would be usually for bond ETF, the liquidity in the market, even though I mentioned it is traded on a stock exchange, liquidity may be an issue for you because not many people trade bond ETF. Spread between the buy and sell, the bid and ask, tend to be wider as well if for a bond ETF. Yeah, so I hope that answers your question. Yeah. Okay. The next question here is a very interesting question. So, what is the difference between ask yield percentage and a coupon percentage for a corporate bond? Okay, so simply put, coupon percentage, right, or the coupon rate in per se, right, is the point in time when the issuer issued a bond. For example, company A issue a bond saying this bond is for 10 years, and for each year I'll pay you 5%. So as an investor, when you buy this bond, you're actually buying a bond that pay you 5% coupon for 10 years. That is what we call coupon rate or coupon percentage. Coupon rate is fixed at a point of issuance. This bond has a fixed coupon rate. What is yield? Okay, so yield, right, actually refers to your actual returns you get by buying into the bond. So imagine this scenario. For that same bond that give you 5% coupon, right? If you actually buy it at 10% higher rate, so instead of paying 250,000, you pay 275,000 for that same bond. But that's 275,000 that you invested into the bond only give you the 5% coupon rate every year, the fixed rate. So what this means, right, because you are buying the bond at a premium, your yield will be lower than the 5%. In the scenario whereby you buy the bond at a discount, meaning instead of 250,000, you buy maybe for 200,000, a 20% discount, you can expect your yield to be higher than 5%. All right, because when you buy a bond that is at a discount, every year you'll still get 5% coupon. So technically you get higher yield in a sense. Not forgetting when the bond matures in 10 years' time, you will also earn an additional 20% because you buy a 20% discount, right? 80% of the face value. But when a bond mature, they'll pay you back full capital. All right. So that will actually result into a higher yield for you if you buy a discounted bond. Right. Okay, so the next question here would be, what are typical bid-ask spreads for bonds in secondary market when you try to close the position? Uh, I would say there's no real fixed bid-ask spread. It's just that because bonds are traded like a OTC, it's or traded on the OTC market, not like your stocks and shares. For liquid counters, for example, DBS, for example, right? The price, the bid-ask spread usually tend to be very tight. But for bonds, uh, bonds may have a large or small spread depending on the liquidity of the bond, as well as how desperate, I would say, a person wants to buy or sell the bond. Okay. So for example, if there's no buyers currently in the market for a certain bond, and you as a seller want to sell, you can actually indicate a price, any price actually, that you want to sell the bond. But if there is no buyer, right, eventually you have to adjust your price to match the market realistically. And then eventually once there's a buyer, then that's how you match a buyer and a seller. Yeah, so for typical bid-ask spread for bonds in the secondary market, I will say it's subjective. It's subjective to the company, the bonds, as well as the demand for the bonds. All right. But just take note, for Phillip Capital, definitely we'll try to get for you the best price possible for any bonds. Yeah, so not to worry on that. Okay, so the next one is asking roughly the same question, for how competitive is your OTC pricing? And I mentioned our pricing will be all inclusive, so there's no additional commission needed to pay on top of the buying or selling of the bonds. So for example, today, if you as a seller feel like selling at 102% of your face value, just indicate 102, and we'll try to match you with a buyer, inclusive of any fees into that 102. So if you indicate 102, we'll sell at 102. Yeah, so there's no additional fees on top of that. All in. Yeah. Okay, next question will be, with foreseeable interest rate cuts, this will also result in decrease in bond yields. Um, yes, yes. So, like I mentioned earlier, the interest rate move inversely related to the bond prices. All right. So usually in a scenario whereby, because currently we are in a high interest rate environment, right? So if you are a current bond holder who most likely buy a bond maybe 3-4 years ago, your bond may be in the rate in the rate. I wouldn't say confirm 100% your bonds in the rate now, but most likely you'll be holding a bond that is paying you a coupon lower than the current market rate, right? So most likely you'll see yourself having a negative portfolio for your bonds. So of course, when interest rates start to cut, you'll start to see an inverse relationship whereby the bond prices will start to recover when the market coupon or market yield, right, starts to decrease. So your bonds, right, will actually get more and more attractive. The more cuts happen, the more cuts there is like in the market, your lower coupon bond will tend to be more attractive eventually, right? So technically in a interest rate, low interest rate environment, or an environment whereby interest rate is starting to cut, bonds tend to perform better. I'll be referring to bonds that's already issued in the market. I'm not talking about new issuance, yeah. Because if a bond is newly issued during a lower interest rate environment, they tend to give you a lower coupon rate, right? So that one it really doesn't affect much to the bond. Usually when there's an interest rate hike or interest rate cut, it will affect the secondary market bonds, means bonds already listed in the market. That's where they will move. Like the price will either go up or down depending on a rate cut or a rate hike. Okay, next question will be, can an AT1 bond have a call or maturity date? Um, the answer is yes, because most bonds will have a maturity date unless it's perpetual. So if it's a perpetual bonds, they tend to have a call date option in place into the bond lah. So actually it doesn't matter whether a bond is AT1 or not, they should have a maturity date, or if they are a perpetual bond, they will have a call date. Okay, so this is a bit similar to the earlier question. So like I mentioned, uh, I think you don't confuse yourself with the lower yields. It's just purely the interest rate. So when there is an interest rate cut, it usually implies a positive movement in your current bond prices. All right. Okay, this next question is, are the bond coupon or dividends received taxable? If it is tax exempt, it will tend to be declared lah. But of course, I'm not the right person to answer you in this case on the tax related matters. So you may want to check with your financial advisors or your tax accountant on this, whether you have to declare tax for your returns on the coupons or dividends. All right. Okay. For next question, just to check, the capital will only be returned at the end of the coupon, right? Okay, the answer is yes. So usually the coupon, or sorry, the company will pay back the capital or the principal amount at the date of maturity. So meaning when the bond matures, you'll get back the full 250,000, for example. So regardless whether you buy the bond at a premium or you buy the bond at a discount, as long as it reach the maturity date and the company has the ability to pay back and redeem the bond, you will get back the face value of the bond, which is most likely 250K in Singapore context, SGD. Yeah, most bonds are issued 250,000. Okay, so next question is a great question. It's linked to our first question, which is referring to bond ETF compared to a corporate bond. So the answer is, the answer is yes. For individual bonds, once you hold to maturity, you get back 100% of the principal amount, assuming there's no default by the company. All right, by buying a bond ETF, you are subjected to the bid and ask price of the current market, and there is actually no maturity for the bond ETF lah. So what this means is you could have bought a bond ETF at $1. However, you could have bought a bond ETF at $1 maybe at the IOP, in the initial price, right? But then because of the interest rate environment, for example now, if because of the high interest rate environment, most likely you'll be current market pricing is below $1, right? So what happens is, since there's no maturity for a bond ETF, you will have to wait until the market adjusts, whether is it a rate cut uh, or the market sentiments for it to go back above $1 before you can actually break even. But for a corporate bond that maybe says has a maturity in 3 years, so regardless whether 3 years ago the person buy and then currently now you're in a high interest rate environment, when the bond matures and the company has the ability to pay back, they'll pay back the full capital, regardless of the interest rate environment. All right. Okay, next question. What's yield to worst? Yield to worst, I think that's mainly referring to the worst case scenario lah. Uh, of the bond, right? Um, or Phillip Capital side, there's no platform fee for bonds. Yes, there's no platform fee for bonds. However, for uh foreign listed bonds, you may be subjected to custody fee. All right. It's best that you actually check with your trading representative before you purchase any bonds, because some bonds may be subjected to custody fee. Yeah. And that will actually affect your overall returns in a sense lah. Okay, so the question here is, how does the Ash I would think that you're referring to the bond 50, right? How it works. So uh simply put, for example, if it's a bond A that's giving 250,000, uh we will actually split that bond into five portions, in a sense, meaning five different investors can choose to buy the same bond. So technically it's exactly the same. So whatever coupon that is paid, right, you'll get the same amount, but it's just that 1/5. Yeah. The same bond will also be subjected to the same maturity date of a normal bond. So sorry, of the same bond. For example, company DBS. For example, DBS give you 5% coupon, mature in 5 years time. If you buy a bond 50 of a DBS, for example, you'll get the same mature in 5 years as well as 5% every year. But your 5% will be based on 50,000 rather than the full 250,000. Right. So the next question will be, while awaiting bond ETF prices to recover with high interest rates now, we are rewarded with the quarterly dividends. Okay. So by buying into the bond ETF, right, depending on which bond ETF you buy, they may pay or they may not pay dividends. And of course, if they pay dividends, it's up to them to decide, is it quarterly, semi-annual, or annual, right? So really depends. You have to do your research, or you can ask your trading rep to see, to actually check for you if that particular bond ETF pays dividend, and if they pay dividend, what's the frequency of the payment lah. Yes, but the answer is yes lah. While holding the bond ETF, waiting for the price to recover, yes, you should still get dividends for those that is paying dividends ETF. Yeah. Okay, so for this question, I think I answered earlier. So depending on the bond that you buy, so if it's a foreign listed bond, then yes, you may be subjected to custody fee. For this, you may want to check with your relationship manager or your trading rep first before actually you buy the bond. Because there are some that actually have to pay a custody fee. But for platform fees, we do not have a platform fees for our bonds. Okay, so for this question is related to the bonds 50 earlier. So the answer is no. You do not need to wait for five buyers Philip in order to buy the bond 50s lah. Because like I say, most of these bonds already listed on the secondary market. So as long as there's a seller for that bond, uh we can actually link you up with that transaction. Yeah, you don't have to wait for all five buyers before you can buy the bonds 50. And that's why I say not all bonds are applicable for bond 50. You may want to check with your trading rep or go to our website to actually see which are the bonds that are applicable for this for bond 50. Okay. Okay, so I'll just leave the particulars for my colleague here. I'm also part of the same team at station at North Point. So if you have any questions, you can actually just give us a call or write into us, and we'll try our best to reply to you lah. All right. So is there any last questions here? So I hope this webinar has have shared a bit more of the bonds with you. And of course, if you have any inquiries related to bonds, whether is it corporate bonds or bond unit trust, feel free to contact us. Then we'll try our best to assist. Uh, Bonds is a very interesting product for you to get exposure to or to be part of your portfolio, as it gives you a very consistent coupon or dividend payment in a sense. Definitely now, because of the high interest rate environment, most bonds are trading at a discount to their face value. So if you can actually get into some bonds at a decent or reasonable price, it could benefit you in the long term once interest rates start to cut. So one thing to take note of is Singapore, we do not really control interest rate. All right, we usually take cue of the interest rate hike or cut based on our trading partners or mainly US lah, I would say. So for bond investors, I would suggest you keep a lookout or follow the Federal Reserve, US Federal Reserve decision, as any decision made by them will most likely affect your bond portfolio. All right. Okay, I see one more question here. So for this question, since price is OTC, holder will not know whether we are selling at the highest price. The answer is yes. So I would suggest if you are a bond holder, sell at a price that you are most comfortable with. Okay, sell at the price you are most comfortable with selling at. So for example, if you're willing to sell at 105, just indicate you're willing to sell at 105. And then they'll actually try to match you to a appropriate buyer. Yeah. There's no like a real high point or low point to buy a bond. Like a stocks, you can see the technical analysis, you can see the highest point in the past 1 year or the lowest point in the past 1 year, and then you decide whether is it worthwhile to sell the bonds. The answer for bonds, because it's traded OTC, you do not have that kind of information or analysis in a sense. All right. So for bond holders, if you really want to sell a bond, sell at your most comfortable level. And then hopefully there's a buyer that's willing to buy at the price that you want to sell at. Right. Okay. So as I don't see any more questions here, I would like to thank everyone again for your time and your participation in this webinar. So I'm Brian again from PA Investor Center, North Point City. If you do have any questions, feel free to contact us, and we'll be more than glad to actually assist you in your investment journey as well. All right. So once again, thank you for joining today, and we'll see you in the next webinar. Thanks.